We do have some new data out today, though, on how CEOs feel about the economy. According to the latest Business Council Conference Board CEO Sentiment Survey, corporate chiefs felt better about economic conditions at the start of the first quarter. However, you got to look pretty deep to make sure that you see the silver lining there. Joining us right now with more on the view from the C-suite is Roger Ferguson. He's the former vice chairman of the Federal Reserve. He's the survey vice chairman of the Business Council and a CNBC contributor. And Roger, the good news is only 93% of CEOs think that they're going to see a recession happen in the next 12 to 18 months. Believe it or not, that's better information. What were we looking at the last time you did the survey?
Thanks, Becky. Well, the last time we looked at the survey on the recession number that you just quoted, it was actually 98%. So it's a moderately improved view. Very importantly, out at the other end, those that think we might have a deep recession, the last time we surveyed, about 13% thought that was a possibility. That's now down to 5%. So I would argue overall this is a less pessimistic set of CEOs right now, but not yet moving to optimistic territory.
I guess the good news is the majority of them think that this will be a shallow recession, even if one does come in the next 12 to 18 months.
No, absolutely true. They think it will be a shallow recession. They also see some easing in some areas of cost pressure, particularly in transportation and energy, which is consistent with other stories. Still, they see very, very tight labor markets. They are expecting to have to increase wages by about 3%. What's very interesting in that number, though, is those that thought they'd increase wages over at 5% is much lower now. And so I think the wage pressure, while still there, may also be easing up just marginally. So I think on balance, less pessimistic. Wouldn't describe it as optimistic, but I think they're managing through this reasonably well.
I think that may be the key, because that's what the Fed is watching so closely right now, the strength of the labor market. We saw that with the better than anticipated jobs number, and everyone started panicking, thinking, this is great news for workers and for the economy, but it may mean that the Fed is going to have to continue to raise rates and keep them there higher for longer. Are you in that camp, Roger?
Look, I've always believed that the Fed is going to get the so-called terminal rate over 5%. I think the incoming data is consistent with that. I think Chair Powell's statements most recently are consistent with at one, probably two 25 basis point hikes. I also think that they'll keep the rates higher for longer than the market currently expects. The market was expecting some easing of rates toward the end of this year. I think that's becoming less likely. But you know, I think that's in some sense not new news. I think it's just the market catching up with where the Fed has been for a period of time.
So do you fall in Jamie Dimon's camp then, too? We just read what he had to say, that he thinks that if these high prices, if they stay sticky, you're going to look at more rate hikes. He said people should be taking a deep breath on this one before they declare victory over what we've seen in a month's numbers.
I certainly think that's always the case. You know, the numbers move around quite a bit. And as we've talked about in the past, I think markets are really hungering for anything that suggests that the Fed's going to ease. And I think markets tend to be overreacting to the numbers that look as though they are inflation friendly, and underweighting the numbers that suggest labor markets are still very tight and the Fed still has some work to do. So I think I would, broadly speaking, be in Jamie's camp. Too early to declare victory on inflation. Importantly, I think Chair Powell specifically said something like that at his most recent set of comments.